Welcome back, investors. Thanks for joining in. Today we'll be looking at Alibaba, a company that has been struggling for some time now. Alibaba has a big problem. They recently got overtaken by Pinduoduo as the largest e-commerce company in China. Their version of AliExpress, called Temu, has been rapidly taking market share worldwide, causing fear amongst investors. Recently, we also got the news that co-founder Jack Ma has bought shares of Alibaba, causing the stock to pop by more than 7%. There are a lot more concerns to talk about in this video though regarding the Chinese Communist Party and their influence on Alibaba, and the weak recovery of the Chinese economy. But in this video, I want to highlight how Alibaba has been performing over the years, and what we think the future will be like based on the numbers that Alibaba has been reporting. Basically, we will not be listening to the noise that we can hear every day from the news, but the financial facts that we can make our own judgment about. Join me in this video of determining the fair value of Alibaba. To look at the past performance of Alibaba, we are heading over to QuantView, our stock insight tool. Here we can see that the numbers do not look as bad as the market makes it seem. Revenue has been in a constant uptrend and the free cash flow seems steady. In terms of margins though, you can see that the company has suffered. Net income margins have gone from 20+% to high single digits, causing metrics like net income and earnings per share to tank. Long-term debt has been slowly creeping up over the years as well, but Alibaba sits on a solid cash pile that can cover these liabilities at any time. Their debt to EBITDA has never been above the ratio that we like to see it at, which is a solid sign as well. In general, we can see the valuation metrics have dropped, like the PE and price to sales ratio, making the free cash flow yield skyrocket. If you want to get your hands on this stock insight tool and the valuation models that we'll be using in this video, make sure to head over to our Patreon, where you can get access to our complete valuation toolset. But without any further ado, let's get to the analysis. We'll be performing our valuation in 3 steps. First is the margin of safety. In this step, we'll be assessing Alibaba's key metrics and ratios to determine if we should be more or less cautious when determining our fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value is of the company based on different metrics. And lastly, we'll combine the 2 steps to give us a fair value of the company. To determine this final valuation of the company, we'll be using our margin of safety. This margin of safety will be based on the financial ratios, the financial health and the growth of the company. I will be using a standard margin of safety of 30%, that can never go below 0%. The margin of safety will be based on a bunch of metrics like we said, and to see how much we should add or subtract from our margin of safety, we use a scale. When we are using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. When we'll be using 3 colors, bright red will mean a 5% increase, orange will mean no change, and light green mean a 5% deduction. The first metrics that we'll be looking at will be focused on growth. Here we'll be looking at the earnings per share growth and the free cash flow per share growth. As you can see, the earnings per share have been in a uptrend for a while now, but in the last 5 years, it has gone down significantly. We have gone from $1.24 a share in 2014 to $4.55 a share. However, the peak was set in 2020 with a earnings per share of $7.09. Since we only take the past 5 years into consideration with these metrics, the growth is only 6.64%, which is in the orange part of our scale, meaning no change in the margin of safety on this metric. The free cash flow per share growth, however, is looking a lot better. It has gone from $2.31 a share in 2014 to $9.53 a share in 2023, also setting a peak in 2020, but it has remained high during these years as well. The average growth rate in the past 5 years has been almost 20%. If it was 20%, we would deduce 10% from a margin of safety, but since it's just slightly below this, we will only be deducting 5% from the margin of safety. Still very nice though. The second metrics that we'll be looking at will be focused on financial health. Here we'll be looking at the debt to EBITDA and the Altman Z-score. To get our debt to EBITDA, you have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And as you can see, the cash position of Alibaba is absolutely huge. It's way more than is needed to cover the debts, making their debt to EBITDA ratio negative. And in this case, it's negative 227%, making us deduct 5% from our margin of safety. Next up, we have the Altman Z-score. And the Altman Z-score is used to predict how likely a company is to go bankrupt. It is calculated with a bunch of metrics like working capital, total assets, total liabilities, and sales to assets. If the ratio is below 1.8, a company is very likely to go bankrupt, and if it's above 3, the company is very unlikely to go bankrupt. Alibaba sits just under 3 at a ratio of 2.8, making it, well, pretty safe, but it's not that safe yet that we will reduce our margin of safety with this. So no change in the margin of safety on this metric. Next up, we have the shareholder return. Alibaba has paid their first dividend, but since we don't know what dividend growth will be like yet, we will not look at this metric in our valuation. We do have share buybacks or dilution though, and as we can see, dilution has been quite high for a number of years, but in 2020 they started to buy back shares. The dilution of the past 10 years here then only stands at 3.38%, which is just under the red part of a scale, so we do not have to add anything to the margin of safety or subtract anything. And lastly, we have the capital allocation metrics. Here we look at return on equity and return on invested capital. First is the return on equity, and this is calculated by taking the net profit and dividing it by the equity. We can see for Alibaba, this ratio is currently sitting at 11, which is no change in the margin of safety on this metric. The return on invested capital is currently sitting at 10% for Alibaba. We of course have to use the invested capital in this formula, and it gives us an idea how effective the management is at allocating their capital. We can see that it is currently, of course, at 10%. It has been much worse years ago, but they have managed to increase it again a little bit. But it's not quite enough yet for us to reduce our margin of safety further, so no change in the margin of safety on this metric as well. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. We can see that the free cash flow has been an uptrend for Alibaba. Going from 2017 to 2023, their average growth rate in their free cash flow has been sitting at just over 25%. And in this valuation model, we'll be determining 3 cases: a normal case, a best case scenario, and a worst case scenario. In our normal case, we have a short-term growth rate of 8% and a long-term growth rate of 6%, and a 10% weighted average cost of capital and a 3% perpetual growth rate, which will be both metrics that we'll use in other cases as well. In our best case scenario, we have a short-term growth rate of 15% and a long-term growth rate of 10%. And in our worst case scenario, a 4% short-term growth rate and a 3% long-term growth rate. I just noticed that I mixed up the names, but the best case scenario is supposed to be what stands here as the worst case scenario, but it doesn't change anything in our valuation. This gives us a sum of all of their free cash flows of $328 billion, and our equity value is determined by adding the cash and equivalents and subtracting the debt, giving us an equity value of $340 billion. Dividing this by the amount of shares outstanding, we get an intrinsic value of $134, which is almost 80% higher than the current price it stands at today. Next, we have the dividend discount model. Since Alibaba has also started paying dividends, we can perform this valuation as well. And we use the $1 that they paid out in this year. I'm projecting a 12% short-term growth rate in the dividends and an 8% long-term growth rate. And we will once again be using the 10% weighted average cost of capital. And this gives us an intrinsic value of this model of $67, which is 11.4% lower than today's price. The next model that we'll be using is the Graham's valuation formula. Here we'll look at a bunch of metrics like the earnings per share that Alibaba is generating, the growth rate projected by Wall Street analysts, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds. That is always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE ratio of a company that is not growing at all should be 8.5. And if we look at all of these metrics, we get an intrinsic value of $60 per share. And with today's price of $75, this is an intrinsic value that is 20% lower. The fourth valuation model that we'll be looking at is the multiple valuation. This model will be looking at similar companies to Alibaba, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is sitting at 19.19. All it's left to do for us then is to multiply the average PE ratio by the earnings per share that Alibaba is generating, which is $7.1. This gives us an intrinsic value of $136, and that is an upside of more than 81%. And the last model that we'll be looking at is the mean reversion theory. Here we go by the theory that a company will always trade above or below its mean. And the metrics that we use to determine this are usually the dividend yield and the PE ratio. But since Alibaba has only been paying dividends since last year, we will not be using this in this valuation model. But we can look at the PE ratio, however. And in this case, we have imported the PE ratio of the past 5 years. And on average, it has been sitting at 23.24, while today's PE ratio is standing much lower at 10.56. This is a deviation of 55%, meaning that the intrinsic value of the stock is $116, and this upside percentage is the same as the mean deviation. Now that we've gone through all of our valuation models, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $103 per share. A margin of safety we've determined earlier, using our standard margin of safety of 30%, and deducting it by 5% for the free cash flow growth and the debt to EBITDA, leaving us with a 20% margin of safety. Applying this margin of safety, we get an intrinsic value of $85 a share, and with the current price of $75, this is an upside of 14%, indicating that per our valuation, the stock is currently undervalued. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and if you want to get access to our complete toolset for investors, you can head over to the Patreon link that will be linked down in the description. Thank you for watching.